Hey, good evening, everyone. Thanks for staying that late for this last talk. So I'm Cyrille. I'm contributor to the f of X protocol, and today I'm going to try to answer the question: Are real-world assets the only way to achieve capital-efficient stablecoins? So. Yeah, that's it. So you may be aware that stablecoins reach its ATH at $225 billion. But what distribution of these stablecoins is truly decentralized? I looked at it, and you'll be surprised, it's only 0.3%. And last time I checked, it was last July, it was 0.5%. That means there's more and more stablecoins being emitted every day that choose the path of centralization. And why are there so many real-world asset-backed stablecoins? The reason is very simple. It's actually probably the most easiest path to distribute a stablecoin because real-world assets are very liquid. Real-world asset stablecoins are profitable. They have perfect peg by design. But what's the single point of failure of all these real-world asset stablecoins? It's just trust. And trust is the old world mechanism of finance. We built blockchains to actually abstract trust. And we now realize that 99.7% of all stablecoins rely on that old world mechanism. So now let's take a look at how FXUSD, which is the stablecoin emitted by f of X protocol, managed to reach the top 30 stablecoins in just 6 weeks while being totally decentralized. So FXUSD is a reserve-backed stablecoin. It's collateralized by Lido Steve, and it's fully on-chain. It's 100% collateralized, reaching unseen capital efficiency. And it has reliable peg by design. It's fully audited with 12 audits conducted by Trail of Bits and SegBit. FXUSD is actually a byproduct of the X positions. X position is a new way to take responsible leverage on ETH. It delivers up to 7x leverage on ETH while having minimal liquidation risks, offering no funding costs. It's only one-time opening fees and closing fees. And it is also 100% on-chain and fully collateralized by Lido Steve. So the way it works, it's pretty simple. Let's imagine you want to take a 5x leverage on ETH. You pledge $200 to the protocol. You will put these $200 into the reserve. So to reach 5x, you actually want $1,000 exposure on ETH, correct? So the protocol will need to borrow the difference, which is $800 of Steve, and it will use a flash loan to do so. So it will put $800 of Steve into the reserve to be able to mint your X position worth $200 and $800 of FXUSD in order to repay the flash loan. And this is how we achieve to mint FXUSD as a byproduct of the X positions. So now the protocol has $1,000 of Steve into the reserve. Your position is worth $200, but you get the exposure of the whole reserve while there is $800 of FXUSD in the market. When ETH prices raises by 10%, the value of the reserve goes to $1,100, while FXUSD value is still worth $800 because it's a stablecoin, right? And then now we use the FX invariant that says that the value of the whole reserve is always equal to the value of all FXUSD in the market and the value of all X positions to calculate the value of your X position after the price raise. And your X position is now worth $300. And this is how we achieve to deliver 5x leverage, because your X position raised by 50%, while the price of the underlying only raised by 10%. Pretty simple. But you may wonder how FXUSD remained pegged while having such a selling pressure when you open the X position, right? There's different pegging mechanism. The first one is the stability pool, and that's another product of f of X protocol, because the stability pool accepts both FXUSD and USDC and delivers 3 different yield sources. The first one is the exposition fees. So as I told you, there's no funding cost in most cases, but there's an opening fee and a closing fee. And most of these fees are distributed to that specific stable strategy. The expositions on FXUSD are collateralized by Lido Steve that generates 2.8% APR a year. And all this yield is distributed to the stable strategy as well. And then there's FXN, or governance token emissions, that are also distributed to the stable strategy. And this is how we manage to distribute a very sustainable and attractive yield on over $36 million right now. There's 22% APR, and there's only 1% APR distributed in FXN emissions. The rest being native yield distributed to the stability pool. And that stability pool acts as a peg keeper. So each time FXUSD is traded below 0.997, the USDC will be used to arb the peg of FXUSD. But if that's not enough, the EMA of FXUSD on 42 minutes could reach 0.998. And in that case, we trigger the depeg mode. In that case, you cannot open any more exposition. There's don't create more selling pressure on FXUSD. And in that specific case, there can be a borrowing cost charged to the expositions, which is what you would pay if you could get that amount of leverage on Aave. But it's totally distributed to the stability pool in order to attract more USDC to arb the peg. So it's very temporary mechanism. And the worst case scenario is if if it's not enough, there's the redemption mechanism that protects the peg. You can always redeem FXUSD against RWAs, and there is a 0.5 redeeming fee, creating like a hard floor of 0.995 for FXUSD. So I told you earlier, there's a liquidation protection mechanism on the expositions. This is what we call the liquidation break. And that's a unique feature of FFX protocol. The way it works is very simple. It basically prevents hard liquidations as you would get on Aave or other CDPs by simply triggering when your exposition crosses 88% LTV. It will always put you back to 88% LTV instead of liquidating half of your debt or even the entire position. And it prevents you to reach the 95% liquidation LTV. So to give you an example, let's imagine you want to take that 5x leverage on ETH with a starting price of $2,500. The liquidation break, the 88% LTV, would trigger at $2,273, and the liquidation LTV would be $2,105 if the rebalancing mechanism, the liquidation break mechanism doesn't work. We have an amazing community member that created a simulation tool. I'll just show you it in just a couple of seconds so you can see how it actually works. So in blue, sorry, you will see the ETH price going down, and the yellow line is the liquidation line, liquidation break line, and as you see when you reach it, if the price keeps going down, your liquidation line in red also goes down. So it only cuts what's necessary to keep the protocol safe, so that you can benefit from a market rebound after the liquidation break mechanism. Keep the maximal exposure as possible. So what we achieved so far is that as I told you, FXUSD managed to reach the 13th place in the all stablecoins on Ethereum in just 6 weeks. There's over 18,000 RWAs TIF in V2. That's over 0.6% of all Lido TVL. Again, it's just 6 weeks. And we deliver actually more than 20% APR on $36 million. And most of it, as I told you, is organic yield, and that's unseen. And moreover, there was 0 liquidations in the last volatility event of this week, like on the 24th and even today. A quick word about the roadmap before we all go get that delicious dinner. We're about to tokenize that crazy stability pool strategy to build FX Save, which is going to be a 4626, able to be onboarded to all the rest of DeFi. We're about to add wrap Bitcoin as collateral as well, so you'll be able to get pretty nice leverage on BTC, being fully on-chain and with minimal liquidation risk and no funding costs. There is a base deployment coming in about a month as well, as to deliver even probably higher leverage and cheaper transaction fees. Limit orders are coming as well to give an even better trading UX, and short positions as well. So yeah, that was it for today. Thanks for staying that late. It was a pleasure to be here with you. Feel free to scan that QR code if you want to learn more, and to grab me at the dinner later. Thanks.